In the ever-changing financial market, an increasing number of derivative products have been launched tailored for investors' needs. To enhance your understanding of derivative products, we will introduce some common types and uses of derivative products and illustrate through examples their respective payoff dynamics, characteristics, risk elements, and other considerations that should be taken into account when investing in these products. A derivative is a contract involving two or more parties, the price of which depending on one or more underlying assets. Fluctuations of the underlying assets will affect the derivative's value. Common underlying assets include stocks, market indices, commodities, currencies, interest rates, and so forth. Derivatives available for trade in the stock exchange include warrants, securities listed in stock exchange with security codes starting with 1 or 2 are warrants. Callable bull-bear contract, securities listed in stock exchange with security codes starting with 6 are callable bull-bear contracts. Synthetic ETF, such as 2823 FTSE A50 China Index ETF. Index futures and options, stock futures and options, currency futures, FX futures, interest rate futures and bond futures, commodity futures, exchange traded notes. Derivative products that are not traded in the stock exchange include equity-linked investments, structured notes, funds with the use of derivatives specified in the investment objective. Before investing in derivative products, you should thoroughly read the offering documents and understand fully the characteristics and risks of the product. You should consult your personal financial advisor if in doubt. Why do investors choose derivative products? Conventional investment tools generate profits only when the value of the asset appreciates, while derivative products offer potential gain even in a stable or bearish market due to their different payoff structures that match market views of investors. Investors can also make use of derivatives to balance the risk of their investment portfolio. Some derivative products may involve leverage that magnifies gain or loss, resulting in 2 times, 5 times, 10 times, or even more of gain and loss. When investing in derivative products, investors may gain potential return larger than direct investment. They may at the same time suffer a bigger loss than direct investment. Other than retail investors, fund managers may also invest in derivatives in order to enhance return, to invest in restricted markets such as China, or to control risk exposure by changing the asset price. To further illustrate the characteristics of derivative products, we will go through some examples. First, we look at call option. An investor has a bullish view on stock A. He purchased a call option on stock A at 1 Hong Kong dollar for the right to buy a share of stock A at 10 Hong Kong dollars on the maturity date of the call option. Let us look at the profit or loss to the investors on the maturity date. If the market price of stock A is at 15 Hong Kong dollars, the investor will exercise the right to buy stock A from the financial institution at 10 Hong Kong dollars. The gain will be the difference between the market price and 10 Hong Kong dollars minus the cost of 1 Hong Kong dollar for buying the call option, thus 4 Hong Kong dollars. If the market price of stock A is at 10 Hong Kong dollars or less, the investor will not exercise the call option as he could purchase stock A at 10 Hong Kong dollars or at an even lower price on the stock market. his loss will be 1 Hong Kong dollar, option price paid buying the option. Be aware that commission and other transaction fees are excluded in the above example. Examples of products involving call option include call warrants, callable bull-bear contracts, CBBC, index futures or stock futures, synthetic ETF traded on the stock exchange, funds investing in derivative products, principal protected structured notes or funds. The second example is selling put options. If the market price of stock A is at 10 Hong Kong dollars and the investor would like to purchase the stock when it is at 9 Hong Kong dollars so that he can gain even if the price of stock A goes up instead, he can opt to sell put options on stock A to the financial institution. Assuming the strike price of the put option is at 9 Hong Kong dollars and the option price is 1 Hong Kong dollar, let us look at the profit or loss to the investors on the maturity date. If the price of stock A on the maturity date is at 9 Hong Kong dollars or above, the investor will gain the option price of 1 Hong Kong dollar, as the financial institution will give up the right to exercise the put options because it can sell stock A at 9 Hong Kong dollars or above. If the price of stock A on the maturity date is at 6 Hong Kong dollars, the financial institution will exercise the put option and sell 1 share of stock A at 9 Hong Kong dollars, and the investor will be obliged to buy 1 share of the stock at 9 Hong Kong dollars. Deducting the gain of the option price at 1 Hong Kong dollar, if the investor sells the stock at the market price of 6 Hong Kong dollars, he will suffer a loss of 2 Hong Kong dollars. Be aware that commission and other transaction fees are excluded in the above example. Examples of products that involve selling a put option include index options or stock options, equity-linked investment, equity-linked notes, structured investment notes, structured funds, funds investing in derivatives. The third example is future contracts. A future contract is an agreement to buy or sell an asset at a certain time at a certain price. For example, the price of a future contract of stock A expiring next month at 10 Hong Kong dollars, and each contract entails 1,000 shares. If the investor purchases one future contract and the settlement price of stock A on the expiry date is 12 Hong Kong dollars, the investor will gain 2,000 Hong Kong dollars. If the settlement price of stock A is at 10 Hong Kong dollars, the investor makes no profit or loss. If the settlement price of stock A is 8 Hong Kong dollars, the investor will suffer a loss of 2,000 Hong Kong dollars. Be aware of the risk of possible margin call and that commission and other transaction fees are excluded in the above example. Examples of products involving future contracts include index futures, stock futures, currency futures, interest rate futures and bond futures, commodity futures, fund investing in derivative products. We learn of the profit and loss generated by derivative products from the above examples. There are a variety of derivative products on the market with different characteristics. Before investing in derivatives, investors should understand the respective characteristics of the products and consider whether they match their investment needs. Now we turn to some common features of derivative products. Derivative products may involve leverage, meaning that profit or loss will exceed those resulting from direct investment. If, for example, the gear ratio is 1:5 and that the value of the underlying asset varies by $1, the value of the derivative will vary by $5. If the underlying assets perform unexpectedly, you may suffer a severe loss. The higher the gear ratio, the higher the risk, and the loss might exceed your principal. References to your view on the underlying assets and your liquidity requirement should be made when deciding the method of settlement. You should also pay attention to the differences when investing in derivative products that are similar in nature. For instance, CBBC and warrants are both options involving leverage. They could be bought from and then sold at the stock exchange, and their values can drop to zero. CBBC are issued with a call price and a mandatory call feature, meaning that if the price of the underlying assets reaches a level, the call price specified, the CBBC will expire immediately and trades will be terminated. Investors might, as a result, suffer a severe if not total loss, and they should be aware of this significant feature of CBBC. If a loss is caused by the unfavourable performance of the underlying assets, you can choose, if applicable, from the methods below to settle. Settle the loss in cash at the current market price, or physical delivery of underlying assets, such as equity converted at the preset price. A mandatory call event might occur on certain derivatives, meaning that early termination might be possible, and the principal will be returned. Be aware that if you invest in other products with the principal returned, you might not gain the same payoff. Investors should be aware of the following before investing in derivative products. A majority of derivatives are not principal protected, and you might suffer a total loss. If it is a leveraged deposit or contracts you invested in, your loss might be multiples of your initial deposit. Some derivatives are packaged as structured notes or debentures. They are not equivalent to general notes or debentures, entailing different risks and rewards. Values of derivative products are linked with performances of their underlying assets. Each derivative product is subject to the market risk of its underlying asset. You should first research into and understand the underlying assets, or request distributors to provide you with the relevant information. You should only invest in products linked to those underlying assets that match your market view. In the event of a derivative product issuer becoming insolvent and defaulting on their listed securities, you will be considered as an unsecured creditor and will have no priority in claims to any assets held by the issuer. Investors should therefore pay close attention to the financial strength and creditworthiness of derivative product issuers. If the counterparty of the derivative defaults or becomes insolvent, you may lose all of your investment. Uncollateralized derivative products are not asset-backed. In the event of issuer bankruptcy, investors can lose their entire investment. Investors should read the listing documents to determine if a product is uncollateralized. Derivative products have an expiry date, after which the issue may become worthless. Investors should be aware of the expiry time horizon and choose a product with an appropriate lifespan for their trading strategy. The price of a derivative product may not match its theoretical price due to outside influences such as market supply and demand factors. As a result, actual traded prices can be higher or lower than the theoretical price. Investors trading derivative products with underlying assets not denominated in Hong Kong dollars are also exposed to exchange rate risk. Currency rate fluctuations can adversely affect the underlying asset value, also affecting the derivative product price. The stock exchange requires all derivative product issuers to appoint a liquidity provider for each individual issue. The role of liquidity providers is to provide two-way quotes to facilitate trading of their products. In the event that a liquidity provider defaults or ceases to fulfill their role, investors may not be able to buy or sell the product until a new liquidity provider has been assigned. Derivative products may also be exposed to the economic, political, currency, legal, and other risks of a specific sector or market related to the single stock, basket of stocks, index, currency, commodity or futures contract that it is tracking. Product payoffs may be conditional. Values of the derivative may change more or less rapidly than that of the underlying asset. Make sure you understand the payoff of risk dynamics. Most unlisted derivative products offer infrequent dealing. You will not be able to sell the product at any time freely. Make sure you have sufficient liquid emergency funds and consider your liquidity needs on investment before deciding to invest. If you sell the product before the maturity date, you may receive an amount substantially less than that of the initial investment. Derivative products are not covered by the Investor Compensation Scheme. Make sure you understand the risks specific to an individual derivative product before purchasing. Consult your personal financial advisor if in doubt.